Jessica followed all the conventional wisdom. At least that's what she believed. Fresh out of college at 25, she scheduled an appointment with an investment professional, exactly what financially savvy people were supposed to do. The consultant exuded confidence and expertise, speaking fluently about portfolio balance, volatility mitigation, and sustained appreciation. Charts projecting steady upward trajectories filled the presentation. He allocated her savings across several managed funds, explaining they were curated by seasoned market researchers who dedicated their careers to identifying opportunities. Jessica left feeling secure, convinced her financial future was in expert care. She authorized monthly deposits of $500 and rarely checked her account again, trusting professionals to handle what they specialized in. 2 decades passed. At 45, Jessica finally opened her investment dashboard after years of neglect. Her cumulative deposits totaled $120,000. The current balance showed $287,000. Not bad, she thought, her capital had more than doubled. Then a conversation with her sister, a recent economics graduate, introduced an uncomfortable question: how much are you actually paying for this service? Jessica had no answer. The thought had never crossed her mind. Together they investigated, and what emerged shocked them both. The advisor's annual commission was 1%. The managed funds averaged 0.8% in operational charges. Several minor costs hid in documentation footnotes. Combined, Jessica surrendered roughly 1.9% of her portfolio annually. That percentage sounds trivial, until you calculate its real impact. Across 20 years on an account that reached $287,000, approximately $73,000 had evaporated in various charges. Had Jessica instead chosen a basic index fund charging 0.03% annually with no advisory commission, her identical $120,000 in deposits would have become approximately $392,000. She hadn't merely surrendered $73,000 in direct costs. She'd forfeited over $100,000 total, the charges themselves plus the compound growth those charges would have generated had they remained invested. Her fee payments exceeded her entire first decade of contributions, and she'd remained completely unaware. I'm Marcus, and I've dedicated 3 years to understanding why countless investors like Jessica unknowingly transfer small fortunes to an industry that routinely delivers inferior results compared to the simplest alternatives available. If you're currently invested somewhere and uncertainty exists about your actual costs, subscribe now. I'm about to expose a systematic wealth extraction mechanism so brilliantly disguised that most victims never recognize they're being methodically drained. I call it the cost illusion, and it's potentially destroying hundreds of thousands in your retirement security. Investment costs possess a particularly cruel characteristic: they don't register as expenses. Purchasing a vehicle requires handing over cash, you viscerally feel the transaction. Paying monthly rent means writing checks that visibly deplete your account. Investment costs operate differently. They vanish automatically. Quietly, from gains you never actually see. Your quarterly report indicates your holdings increased 7%, triggering satisfaction. What remains hidden? The broader market rose 8%, and 1% dissolved in costs before reaching your account. The wealth evaporates before arriving, so you never experience it as a genuine loss, just moderately smaller appreciation that seems normal. You assume investing naturally looks this way. This obscurity is intentional. Decades ago, the financial sector discovered that consumers tolerate substantial costs when structured as percentages silently subtracted rather than invoices explicitly demanded. Let me detail the extraction layers, because most investors remain oblivious to how many parties are profiting from their capital. Managed funds impose expense ratios, annual percentages of total holdings covering operational expenses. Typical actively managed funds charge between 0.6% and 1% yearly. That appears negligible until you realize it applies annually to your entire balance, whether the fund profits or loses money. A 1% ratio on a $500,000 account means $5,000 annually. Every single year, perpetually. But expense ratios represent merely the foundation, numerous funds also demand sales charges, either front-end fees claiming a percentage when you invest, or back-end fees extracting a percentage when withdrawing. A 5% front-end charge on $100,000 means only $95,000 actually gets invested. You begin 5% underwater before markets even open. Then come 12b-1 charges, promotional and distribution costs that funds impose to finance advertising and compensate brokers selling the fund. Often buried within expense ratios, sometimes charged separately, you're literally financing the fund's marketing campaigns to attract other investors. You're subsidizing your own dilution. The truly fascinating part, most people assume these costs at least purchase superior returns. They're paying for professional management, sophisticated analysis, genuine expertise. The empirical evidence is absolutely damning. According to SPIVA scorecards published annually by SP Dow Jones Indices, over the latest 15-year measurement period, approximately 92% of large-cap actively managed funds underperformed the SP 500. Worth repeating, 92% of funds charging 1% annually to exceed market benchmarks failed to exceed those benchmarks across 15 years. This isn't selective data presentation, consistent patterns emerge across decades and virtually all investment categories. You're paying premium prices for statistically inferior outcomes. The industry marketing expertise is measurably delivering the opposite at elevated costs, advisory layers pile additional extraction on top. Jessica's advisor collected 1% of assets annually as a consulting fee. For what exactly? Selecting underperforming funds and occasionally calling to recommend patience. That 1% on a portfolio averaging $150,000 across 20 years extracted approximately $30,000 paid for guidance that left her financially worse off than purchasing a single index fund and consulting nobody. Combining advisory commissions with fund ratios, trading expenses, administrative charges, and miscellaneous extractions, investors commonly surrender 2% or more annually in aggregate costs. That 2% might seem like background noise, but across a 40-year career, it's financially devastating. Consider this calculation, because it fundamentally shifts perspective. Two investors both beginning with nothing at age 25. Both contribute $500 monthly for 40 years. Both achieve 8% gross market returns annually. Investor A pays 2% in combined costs, netting 6%. Investor B pays 0.1% in combined costs, netting 7.9%. After 4 decades, Investor A holds approximately $1 million. Investor B holds approximately $1.7 million. Identical contributions, identical market conditions, $700,000 difference. That 1.9% annual cost differential compounds into $700,000 of obliterated wealth. This isn't arithmetic error. This represents the actual, documented, verified impact of costs on long-term wealth accumulation. The psychological mechanism sustaining this system, the differential remains invisible throughout. Year 1, maybe a few $100. Year 10, perhaps a few thousand. No single moment exists where extraction feels dramatic enough to trigger alarm. Like a tire losing pressure slowly, you don't notice while driving, you just eventually find yourself stranded. By the time awareness arrives, decades have elapsed and the wealth has transferred permanently. The financial industry engineers wealth extraction in increments sufficiently small annually to avoid triggering reaction, yet sufficiently substantial cumulatively to redirect major portions of your net worth from your future to their revenue. You might think ETFs solved this problem, that the migration toward low-cost exchange-traded funds eliminated these traps. Partially accurate. Average ETF expense ratios dramatically undercut average mutual funds, with some index ETFs charging merely 0.03% annually, but ETFs carry their own hidden costs. There's the bid-ask spread, the purchase price versus sale price. For heavily traded ETFs, this remains minimal, but for smaller or specialized ETFs, spreads can consume 0.1% to 0.5% per transaction. Frequent trading accumulates significant costs. Securities lending occurs when ETF providers loan fund holdings to short sellers, keeping portions of generated revenue. You're not charged directly. But value created by your assets doesn't fully benefit you. Then advisors and robo-advisors wrap low-cost ETFs in high-cost services. A robo-advisor charging 0.25% atop underlying ETF costs transforms a 0.03% product into a 0.28% product, nearly tenfold multiplication. The ETF revolution reduced costs, but the industry creatively reintroduced costs elsewhere. Here's genuine protection from the cost illusion. First, know precisely what you're paying, actually know, not vaguely assume. Research the expense ratio of every holding. Request from your advisor, in writing, complete fee breakdowns including advisory charges, fund costs, trading expenses, and any other extractions. If they cannot provide clarity or seem evasive, that communicates volumes. Second, default towards simplicity. A single total market index fund with sub 0.1% expense ratios will outperform the vast majority of complex, expensive, actively managed approaches long-term. This isn't speculation, it's what empirical data has demonstrated for decades. Vanguard, Fidelity, and Schwab all offer index funds with 0.3% to 0.04% expense ratios. Third, calculate lifetime mathematics on any cost before agreeing. A 1% advisory fee sounds reasonable until you compute it will consume $500,000 across your investing lifespan. Would you write a $500,000 check for services being received? If not, why pay it gradually over 40 years? Fourth, scrutinize advice value. Some financial counsel genuinely merits payment: complex tax optimization, legacy planning, behavioral discipline during market chaos. But surrendering 1% annually for someone to select mutual funds and distribute quarterly newsletters almost never justifies the expense. If advice is needed, compensate hourly or project-based, not as asset percentages that escalate as your wealth grows. Currently, you probably perceive yourself as investing responsibly, trusting professionals, following conventional wisdom. That identity feels safe and prudent. But consider an alternative perspective. You might be surrendering tens or hundreds of thousands across your lifetime to an industry statistically underperforming the simplest possible alternative while maintaining sufficient confusion that you never notice. Complexity isn't sophistication, complexity obscures extraction. Jessica trusted experts and it destroyed over $100,000 of potential wealth. She's not unusual. She represents the average outcome for people paying average costs receiving average underperformance. The system isn't designed to build your wealth. It's designed to build industry wealth using your capital, slowly, invisibly, across decades. You can continue fueling this machine, or you can purchase a simple index fund, pay virtually nothing, outperform 92% of professionals, and retain your own capital for your own future. The decision belongs to you entirely. If this transformed your investment perspective, engage with this content and subscribe. I'll see you next time.